In January, silver hit an all-time high of $121 an ounce. 5 months later, it has lost more than 40% of its value. This was one of the fastest precious metals crashes in decades, and it was not caused by a collapse in demand. I'm going to explain the mechanism behind it, calmly and step by step, with no hype, and nothing here is personal investment advice. First, the run-up. Over roughly 14 months, silver climbed from around $40 to over $120. That rally was built almost entirely on two expectations: that the Federal Reserve would keep cutting rates and that the dollar would keep weakening. But much of that buying happened on borrowed money through futures contracts that let traders control a lot of silver with only a small deposit. That deposit is called margin, collateral the exchange holds to cover potential losses. When silver pushed above $100, the CME, the world's largest futures exchange, sharply raised those margin requirements. Suddenly, traders who had borrowed to buy had to post far more collateral. Many could not or would not, so they sold. That selling pushed prices lower, which triggered more margin calls, which forced even more selling. The unwind fed on itself. At the same time, the macro picture turned. In March, the Fed signaled just one rate cut for the entire year, a hawkish hold. With oil above $100 keeping inflation hot, real yields rose and the dollar strengthened. And a stronger dollar pressures every asset that pays no interest, like silver and gold. Today, silver trades near $64 and gold near $4,165, both down sharply from their January peaks, even as central banks keep buying. The lesson isn't that the metal failed, it's that leverage and a rule change can move a market far faster than fundamentals alone. If this made the mechanics clearer, subscribe for calm breakdowns of gold, silver, and the dollar. Next time, why central banks keep buying gold even as the price falls.